Pearler has just launched Pearler Super, which is of course their superannuation offering, and in this video we'll be taking a look at its features, investments, as well as fees. Let's jump into it. So first off, you have the very simple sign up process. Enter in your basic details including your ID information, which the team will verify. Then at the end your application will be reviewed before being accepted. Now if you've seen the marketing around Pearler Super, you'll quickly realize that this superannuation product is open to everybody except for boomers. And I was looking at some comments and some articles on LinkedIn and stuff, and some people were super salty with the fact that this is not open to anybody before 1970. But personally, I kind of like it. I like the fact that it's tailored towards the younger crowd. I don't imagine many boomers would be using Pearler anyways as a broker in the first instance. I would imagine that they would go towards many established alternatives that are already out there, like CommSec and so on. Anyways, let's take a look at the investments on offer with Pearler Super. So we're in the platform now, and the platform gives us these two choices. So firstly, you've got the all-in-one ETFs, and then you've got a custom pick, which shows you what ETFs you want to select based on your custom filters. So firstly, we'll go into all-in-one ETFs and see what they've got to offer. And immediately, if you've been investing for quite some time, you can see that these are very familiar names. You've got VDHG, which was once the ETF, which basically everybody recommended to each other on online forums and stuff. And then came along DHHF, which is basically a slightly higher growth version of VDHG, to put it in summary. Then you've got DZZF, which is an ethical version of DHHF. And then you've got some other ETFs from Vanguard as well, which have a slightly higher allocation towards bonds. So these tend to be slightly more conservative than the VDHG counterpart. But regardless, these ETFs will be giving you global exposure to basically every market that is out there. Almost every market. So you're going to be getting the emerging markets, you'll be getting the developed markets, the Western world, as well as a lot of other things as well. So these are decent options that you can pick if you want to be very globally diversified. And that's the thing with ETFs like these. These are very much set and forget ETFs, which is why Pearler has probably decided to put this one first so people can just pick something and go from there. But next up, we're going to be looking at the custom pick. So once we go into it, we've got a few options. We've got equity-based ETFs, we've got bonds and fixed interest, which adds a level of defensiveness to your portfolio should you wish to invest in this. Then you've got geared as well, which I thought was pretty interesting. I didn't really think that geared ETFs would be included in a product like this, especially a self-directed product, but where people can actually invest themselves. But this can be quite risky too, so keep that in mind. And then you've got everything, which lists out everything that is out there. So we'll jump into the equity ETF now, and it gives us a list of markets to consider. I'm just going to select all to see what we've got. Again, I'm going to select all, but these are the specific sectors that you guys can invest in, the specific themes too. And we are just going to go with most popular here and see what we've got. So you've got the standard ETFs, which you may have heard about. So you've got VAS, you've got IVV, VGS, NDQ, and a few other thematic ETFs as well. You've got some high yield ETFs too. FANG is there as well, which is pretty interesting. And you've got some other thematic ETFs from the list to choose from, as well as GPEQ, which I covered off in a different video, the private equity ETF, which I thought again was very interesting for them to include that too. Of course, comes with a pretty high management fee. Jumping into the previous one we have, which is bonds and fixed interest. Again, you would only really pick this if you want to add a bit of defensiveness to your portfolio. So these will generally remain stable in times of volatility. So if you look at these ETFs and look at the past history, if you look at what happened during COVID, the little crash that we had, as well as the 2022 downturn, as well as whatever the hell is going on right now in 2025 with Trump and tariffs, you'll find that these ETFs generally remain pretty stable, and they give you that stable source of income to alter your portfolio, so it is a lot more defensive. So you've got the geared US ETF, you've got the geared Wealth Builder ETF, GHHF, which is again very similar to DHHF, which we had a look at, but this is really the geared version of that, so it's a bit more higher risk because the ETF fund managers are using risk to manage these portfolios. So that means that if the index itself goes up by, let's say, 1%, these ETFs would increase by, say, 1.3% or 1.4%. So they are going to be a lot higher than what the actual index is doing. So it's a lot more risk, but it's a lot more return as well. And the same goes backwards as well. So if the index drops by 1%, these may drop by 1.3, 1.4%, and so on and so on. So it can really go either way depending on what the market's doing. So be careful with this. You've got GEAR as well as GNDQ, which is a geared NASDAQ 100 ETF. And you've got geared MVW as well. And then lastly, I want to show you guys a quick scroll through of everything. So this will just include a full list of everything we just had a look at. And there's a lot to choose from, which I think is pretty good, especially for a product that has just launched. I think that there are a lot of familiar names on here for people to consider and easily get comfortable with investing in their super. Now, let's jump into the fun part of this video, which is portfolio construction. So the first portfolio I'm going to construct, and again, this is not financial advice, this is just a look around to show you how the portfolio construction part works with Pearler. We're going to create a very high risk, technology focused portfolio. So we're going to start off by firstly choosing some thematic ETFs. So firstly, we'll go with HACK, which is the cybersecurity ETF. Then we have got robots, which is the robotics and the AI ETF. And it is a lot cheaper than the other alternative you've got, which the management fee is 0.82. This one's 0.57, which will add up a lot over the long term. So we'll choose the cheaper option. Then we've got AC/DC, which is of course the battery and lithium ETF. Then we're going to pick FANG, which tracks the FANG companies. You've got Facebook, Apple, Netflix, Google, etc., etc. Then we're going to choose GNDQ just to throw some leverage, just to throw some geared exposures in there too. And then we're going to finish off with GEAR, which is the Australian geared ETF. So we can see this is quite a risky portfolio. There are very, there's a lot of thematic picks in there, and that's going to make up quite a decent chunk of the portfolio. So I, once again, do not recommend this at all. This is just to show what the platform is capable of. So now we're going to select continue to see what we've got. So with this, I'm going to choose HACK as an allocation of, let's say, 10%. So this is what basically Pearler will allow you to do. You can choose what your allocations are going to be. So for the thematic ETFs, I'm going to go 10, 10, 10. We can see that we can't actually go more than 10 for robots or AC/DC because that is the max allocation that the system allows. We've got FANG here, so let's just go 20% to FANG. GNDQ, let's go 25 again, the max. GEAR, let's go as max as we can go, which is 23%. And you guys can see that the cash balance is a minimum of 2%. I can't actually alter this. This is done purposefully by Pearler, and the reason being is because it is put towards your next purchase. So any leftover cash is there to fund liquidity as well as any sort of admin fees. So just keep that in mind. You can't change the 2% cash allocation. So there we have it. This is portfolio number one. It is quite a risky portfolio. We can see it gives us a total ETF fee, and it's weighted by whichever ETF that you chose. So the total fee of the ETFs themselves only is going to be around 0.45%. Then we can go next. It gives you an option to review your allocations if you like it or not. If you don't, you can of course change it back. So that is portfolio number one. Let's look at portfolio number two. Now let's say that you're somebody quite sensible and you want an all-in-one approach to your investing. So we're just going to keep it pretty simple and go with DHHF, the Diversified All Growth ETF. We can see the max allocation is 100%, so you can actually go fully towards this ETF and you'll be fine. 98% of it can go towards DHHF, 2% allocation towards cash. We can't change that, but that is one option for your portfolio. Now we're going to look at portfolio 2.5, let's call it, which is going to be very similar to what we just had a look at. This is the VAS and VGS split, which is quite commonly recommended in forums and things and whatnot. But of course, do your own research. So again, we'll go into the weightings. We can do, say, 20% to the Australian market, and then VGS can be the max here. But as I'm doing this, I realized that the max allocation for VGS can only be 50%. So if you do want this type of split, you do have to do 50% into the Aussie market, which to some of you may not want to do. So just keep that in mind. You may be better off just choosing other alternatives if you want to get a similar exposure. And the third and final portfolio we're going to create today is the ethical portfolio. So we're going to pick DZZF, the ETF that we just had a look at. This is again the sister ETF of DHHF. It is just an ethical version of it. So we'll select this, and then we are also going to pick Ethi for a more targeted approach. Again, we can go into it and select our allocation. So let's say DZZF, we want an allocation of 75 and the rest towards Ethi and 2% cash and so on. So to keep everything simple, we're just going to select DHHF and go towards the max allocation of 98%. We'll go next, confirm, and this is the screen that you see. So this will show you that your target portfolio has been created and your new balance will take effect immediately. And there we go. It is that simple to do, to select your portfolio. Now let's talk about fees with Pearler Super, because as responsible and conscious investors, we want to take note of this because fees can impact your returns over the long term quite dramatically. So we do want to be careful with this. So let's jump into the fees page with Pearler, and they've given you a sample of what Pearler charges. So Pearler themselves will not charge you a management fee. so this is 0%. Then you've got the ETF management fees, which are the fees that we just had a look at with those individual ETFs. So these fees do start from 0.035%, but as we saw, they can go up to over 1% with those specific ETFs. But if you're targeting broad market ETFs that track the global market overall and the large market, the large indices, then the fees generally will be quite low. So that is fee number 2. Then you've got the admin fees that Pearler is charging, which is about 0.438%. These are fees that are charged. Some of these fees are charged to Pearler, which then Pearler charges to you, but keep that in mind. Then you've got the brokerage of 0.11%. This is for buying and selling. Some things you want to note with these fees is that there is a 1.5% per annum cash fee. So if you are leaving the 2% cash, which you will have to do if you use this product, a 1.5% fee will be charged to that cash balance. But if your cash balance is quite low, then of course the fee is going to be quite low as well. It's not going to be too dramatic for you, but keep that in mind. And the 0.11% brokerage adds up to around $6.60 per year if you're investing around $500 every single month. So that is what the fees would be. So it's not really that pricey. Looking at the examples here, we can see that as your annual average balance grows over time, the cost per annum also grows, of course, but it doesn't grow at the same rate or the same amount. So at a 10K balance, you'll be getting charged yearly 0.496%, but then on a balance of 100K, this slightly drops down to 0.443%. So it's a slight drop there. But generally speaking, on an annual basis, you can expect to pay around 0.45% for your investment, up to 0.5. But of course, it could be more as well, depending on the types of ETFs that you pick. So it all adds up. There are different components. So be careful and read the PDS. I highly recommend reading that because that breaks down every single fee and goes into the specifics of when it might be charged and why it's charged and so on and so on. I might make a separate video that dives into all of that, but that'll require a whole 10 minutes to go in through every single component. But generally speaking though, this is what you can expect to pay. Now I've got 3 important things for you guys to consider if you're thinking about using Pearler Super. Number 1 is going to be insurances. Pearler Super currently does not have access to any sort of insurance. So insurance such as life insurance, TPD, income protection, all of this is not available with Pearler Super. Just keep that in mind. These insurances are normally included in other super funds and other large industry super funds. So these are done automatically. We don't really think about them, but with Pearler, this is not available. So in case you're somebody who is thinking of bringing everything across, you may lose access to some of these insurances, so keep that in mind. If you're unsure about what these insurances cover, what it's all about, I would strongly recommend speaking to a financial advisor because they can really sort this out for you. These guys are the experts when it comes to this, so be mindful. This stuff is pretty important because you want to make sure that you're covered and you're not left exposed to not having any sort of insurance when life's ups and downs happen. Number 2, this is quite important. If you're using a product like this for the very first time, you want to be really careful, mindful, and responsible as to what you're investing in, because traditionally, if you're with a normal super fund, a big super fund, all those decision-making skills fall on you. So you want to be really careful that you understand each ETF that you're buying, that you understand what you're investing in, that you don't follow the hype, because this money is your retirement money, right? You can't access this for a couple of decades from now. So you want to be really careful that everything that you're buying, you fully understand, and that you're not just buying it because somebody on YouTube or somebody on Reddit told you to buy it. So keep that in mind. This is very important. This is not like your traditional brokerage portfolio that you can just buy and sell whatever you like. This is your retirement money. Number 3, this is not an SMSF product. This is different. Yes, Pearler Super allows you to choose your own investments and you're effectively a self-directed investor, so you can have control over what you're buying, but you are not classified as investing in your SMSF. Just something to note. Hope you guys found value in this video. If you found this useful, check out this video right here, which talks about Pearler, the actual brokerage, and how to buy and sell stocks on Pearler as a beginner. So check this out. I'll leave a link in the description as well. And guys, thank you for watching. I'll see you in the next one. Bye now.